Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's sponsor is Building Insurance and Risk. Don't put your real estate investment at risk. Work with Building Insurance and Risk to receive multiple coverage offers and with a side-by-side coverage comparison at buildinginsurancerisk.com. Today, my guest is Raphael Collazo. Ralph is a licensed commercial real estate agent who specializes in investment properties. He's also the author of Before You Sign That Lease and Before You Buy That Building, comprehensive guides to leasing and buying commercial real estate. And in just a minute, we're going to speak with Ralph about how to analyze and assess retail real estate investment opportunities. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, we would love to have you subscribe. With that, I want to welcome my guest, Ralph. Welcome to CRE PN Radio.
Hey, Darren. It's great to be here. I'm excited to learn, talk a little bit more about retail, which is one of the focus areas of what I do. So.
Yeah, well, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. Yeah. And it's somewhat interesting. It's not necessarily a direct jump right into commercial real estate. So I actually am an engineer by trade. So I studied industrial engineering and economics in college and then got into the software business. I was a software implementation consultant for a company that implements software systems for government agencies around the country and abroad. So I had the opportunity to work in Washington, D.C. for a couple of years. I worked on a big project in Puerto Rico to replace the financial software system for the island, and then moved over here to Louisville, Kentucky, where we helped replace the financial software system for the city. Back in mid-2019, I actually transitioned into commercial brokerage, and I've been doing it ever since. And so that's kind of a quick high-level overview of myself. My dad was in the military as a physician, and so I actually was born in Northeast Italy. My mom's Italian, and I lived in Europe until I was about 14, and then moved to Arizona, where I went to high school and college. So got a very diverse background, but I apply those experiences to hopefully better serve my clients in a variety of different facets. So.
Oh, that's awesome. I've always thought travel is one of the best educations you can get, just from kind of a world perspective. And it sounds like you've clearly had that unique opportunity. Hey, I wanted to ask you, so you mentioned by training, you were an engineer. Sound like you're fairly involved in doing a lot of projects there. What was it that attracted you to real estate?
Yeah, it's a great question. It's a question that I get a lot, and they're always like, why did you leave the software business? It seems to be a very, a prosperous industry and enterprise. And it definitely was. But in the role that I was in particular, it was a consulting role. So I was, moving every couple of years. As far as the sustainability aspect, it just wasn't. So if I wanted to be able to, start a family, I didn't want to move my family every 2 to 3 years. So that was one facet as well. And then number two, I've always been somewhat entrepreneurial. I had a small catering company in college, and I had, after college for about a year, I had tried to grow that business, and I thought I wanted to be a restaurateur. Realized pretty quickly after I started managing a restaurant that was not what I wanted to do. But I always had that entrepreneurial fire that I wanted to kind of tap into, and so that's what initially got me thinking about the idea of doing something different. My mom is a residential agent in Arizona, and she's been very successful at it. She actually started pretty much in the midst of the recession, her career, and then kind of grew it to a pretty sizable amount. And, she kind of encouraged me to get my license even back when I was in high school, but you don't really listen to your parents when you're that age. And so, when I started thinking about different things to do, I started looking at the brokerage side, primarily on the residential side, to see if it would be something I would be interested in. And after doing research and talking to a lot of people, I just realized that it wasn't didn't fit my personality type that well. But when I started doing more and more research on commercial, it seemed a lot more in line with what I like to do. And so I gave it a shot, and so far it's been great.
Yeah, no, I can appreciate that 100%. The emotional side of residential is never, um, I don't know. Making the decision when you're making the purchase is one thing, but leading others through it seems like a different kettle of fish there, kind of thing. So anyway, so now you are a commercial broker in is it Louisville or Louisville? I know. How do they?
Depends on who you ask. Depends on who you ask. Right?
Locals there. All right, Louisville.
They say Louisville.
Louisville.
Right.
Louisville.
There you go.
All right. All right. And that borders Indiana. Is that right? Is that
Yeah.
What's the metro area? What's the area? Describe the area and kind of the size of it.
Absolutely. So the Louisville metro area is roughly 1.3 million people, and that encapsulates part of southern Indiana as well. So Louisville's located on the Ohio River, and so it's split. It's the city itself is on one side, and then on the other, directly across the river, is part of southern Indiana. And so we have a city called Jeffersonville and New Albany, which are the bigger cities in that southern part of Indiana that is closest to us. We're about an hour and change away from Cincinnati, about 2 hours away from Indianapolis, 2.5 to 3 hours away from Nashville. So we're pretty centrally located in the Midwest area. I guess it's considered, Kentucky's considered south, but it also has that, it has that southern feel. But yeah, that's kind of a brief overview of the geographic makeup of the area.
Got it. And as far as the metro size, how large is the
it's roughly 1.3, about 1.3. Okay. If there was a joining of the city in the past. So now Jefferson County, I think Jefferson County is the main county that encapsulate Louisville, and I think they have around 750. But if you factor in the entire metro area that feeds into Louisville, within if you look at downtown and you draw a 25-minute or 30-minute circle around it, you're looking at about 1.3 million people in the metro. Okay. So we're in the top 50 cities in population size.
Okay. No, I wasn't familiar with, or hadn't really thought about the size of the area there, but definitely an area to contend with. Like I said, the top 15. That's good.
Top 50, yeah.
Top 50. Okay.
Yeah.
And so what, and you focus primarily on retail, or do you tell me a little bit about your practice?
Absolutely. So I'm with a boutique brokerage locally called the Grisanti Group. We were started by our broker, Paul Grisanti, who was in the restaurant space. Him and his family owned restaurants in the area, and they decided to transition away from that into the brokerage side. And so as far as our specializations of what we do, more so than anything, and I've done multifamily deals, I've done office deals, I've done industrial deals, but where my main focus area has been as of late has been the retail side, in particular on the investment end. And so, that's, I guess, more so a function of the brokerage I joined. Because again, when you first get into the business, you don't really know anything about the different property types or what you may or may not like. And so, I think a big reason why people specialize in a certain thing is either A, the position entails that you specialize in it, or if you're at a boutique brokerage, you just kind of find where you fit.
Got it. Okay. So the news of late, COVID, et cetera, post-COVID, has kind of led one, or at least myself, to believe that obviously office is probably the most, damaged or challenged by the situation, but that also there were some challenges in retail. Can you describe kind of the current situation in your market and vacancy and demand? Is there any new retail being built? What's the story there?
Yeah, of course. I mean, there definitely is new retail being built. I would say more so on the higher end. Obviously the higher price per square foot, you can justify the development in certain areas of town. But as far as retail is concerned, we actually had the honor to interview on our podcast James Cook, who's a a top the top research analyst for JLL for the Americas, and we kind of talked a little bit about the retail environment and how it's shifted since COVID. And as far as retail is concerned, you hear the things in the news about online taking over and retail just diminishing, and that's definitely still true. I mean, you don't want to diminish the impact that online has had on the retail environment, but since COVID has started to normalize, you've actually seen an increase in retail activity outside of online, and so the numbers of purchasing as far as retail is concerned online have dropped a decent amount since COVID has started to normalize. And so that kind of showcases that the American consumer is still very active as far as getting out there and purchasing, in storefronts, essentially. So as far as, the retail environment currently, I think the biggest challenge going forward is going to be how we're handling inflation right now. The numbers have just recently come back for June, which I've been following pretty closely, and it's actually increased month over month, roughly 1% from what it was back in May. And so that's not a good sign as far as, where we are currently. And so I believe that, the Fed is going to be meeting in a couple of weeks to discuss what actions they can take to kind of quell that inflation. And I'd imagine it's going to require, an additional, pullback as far as, or increasing of interest rates, which, is obviously going to affect a variety of different industries, not just retail. But that's what I would be more concerned about as far as retail, but that's really more so for the economy as a whole.
Right. No, and I look at that as I can't really control that. I just know that it's a constantly moving thing. They're constantly tinkering with it, and sometimes
Yeah.
they're putting the rates too low for too long, which gets us to this point where you have to correct and
Yeah,
then go through the pain.
And a big thing is the supply shock. I mean, we can't
Yeah.
control how the supply chain has been affected. And, obviously with geopolitical issues that have been prevalent right now with Russia and other countries, I mean, that's causing issues as far as the supply chain is concerned. And, that's putting pressure on, oil processing of refining of oil, which is, I think, one of the biggest bottlenecks right now. And since oil prices are an input in a variety of different goods and services, I mean, obviously that's going to cause inflation. And so, that's I think what the Fed is going to be trying to manage is they're going to have to be concerned with, obviously inflation's out of control, but we don't want to put ourselves in a situation where you have an economic slowdown and inflation continues to rise, because that's what happened in the 70s with the oil embargo, is you got into stagflation. And so I think they're trying to manage that as best they can, and it's going to be it's going to be a fine line to tread over the next several months. So
Yeah. No, we're in it. We'll get through it, but not fun in it. But see what happens. So talking about retail, you mentioned that there's definitely some new construction going on. Are there vacancies in older properties, or what kind of the overall? I mean, are businesses opening up in spaces, or are current businesses leasing larger spaces? I
yeah.
mentioned that the online is kind of waning, and people are looking for that local or the physical experience. What are you seeing just on that? Tell me a little bit more about that.
That's a great question. And I think that it depends on the type of retail that is being talked about. I think a big part of like restaurants, for example, in particular, fast casual drive-through restaurants, they're going gangbusters. I mean, they're looking for space on a regular basis. Obviously experiential retail, I'm representing people who are looking to open up tattoo shops. They're looking to do, things that cannot be replicated in an online forum or an environment. That's still very active. As far as Louisville's concerned, we have a very strong culinary presence. We have Sullivan University, which is a very well-respected culinary institute, and other institutions that can support the culinary scene. And so as far as restaurants are concerned, you can't find second generation restaurant space, meaning that it's already built out as a restaurant here. It's just impossible. I mean, obviously, to the level with which you can operate, because, a big concern for a lot of people right now is build out costs. Obviously to build out a space to a specification that you would need to, with rising labor costs, with rising costs of materials, it's becoming very, very expensive. So the demand for move-in ready space is higher than it's been since I've been in the business. And so, those types of uses are still very prevalent. As far as new developments are concerned, I think a big one that we've been pushing for quite some time that it had some contention early on here in Louisville was a Top Golf. I don't know if you're familiar with that business, but essentially it's a restaurant slash bar that you can hit golf balls, and it's like a driving range, but that's a big one that's happening here in the East End that they've been trying to push through for the last several years. But there was some contention at the local level for a rezone to be able to allow for it. And that's one thing that I think, obviously is going to be unique to each individual, city, but, whether or not the city is supportive of development is another factor. And I think the city itself historically has not been the greatest with that, but I think with new leadership that's coming in, there's going to be a lot more support for those types of uses, which is promising.
Got it. So I was curious, you mentioned kind of the restaurant space and demand, and talking about that fast, the fast
Fast casual.
casual. Yeah. There was in the beginning of COVID, there was kind of at least a thread of these kitchens for like delivery for like I don't know, DoorDash or Grubhub or whatever these things were. And I don't remember what it was called, but it seemed like there was some sort of a more of just a kitchen kind of a thing where meals were prepared and delivered. Is that, you see any of that, or is that anything that's got any kind of momentum?
Ghost kitchens.
Ghost
Yeah.
kitchen.
So there are some ghost kitchens in town. It's not as prevalent as in other markets. I know, like, obviously in the larger markets where rent pricing is absurd. I mean, it's going to be a lot easier for you to be able to break into the restaurant space by utilizing ghost kitchens. As far as here's concerned, depending on where you're located in town, I mean, you can still get in at relatively reasonable rates. Obviously, if you're starting to look into the East End, which is kind of our, more affluent area, then you're going to be probably charged a lot more. But then again, it's a function of what your sales are, what you project your sales to be in that area. Then you can maybe afford it or not. But yeah, I would say that ghost kitchens are definitely here in Louisville, and there's people utilizing those. And I always encourage people that are looking to start a restaurant to either A, consider a ghost kitchen, or B, look at the food truck route, just to provide a proof of concept. And then from there, once you build up enough of a clientele and you establish a proof of concept, then, committing yourself to a space long-term is probably a more reasonable approach. But yeah.
Yeah, I love the fact that there's some steps that one can take and really, like you said, test and prove the concept before you go and sign up for the full Monty kind of thing, and be more improve your chances of success, which I think everybody would is a fan of. So let me ask you. So in your role, are your efforts spent more on leasing space or on actually sale of retail assets?
So that's a great question. I do a little bit of both. I'm at a boutique brokerage. I'm not at a large house like a JLL or Cushman that, you specialize in tenant rep, or you specialize in, property management, or you specialize in the, sale and buy side. For me, I do a lot more on I do a lot on the leasing side, but also on the acquisitions and sales side, on primarily retail centers, small strip centers to mid-sized strip centers. And so that's kind of what I do a lot of.
Okay. And on the sales side, are most of the buyers, I guess, and the sellers, are they individuals? Are they syndications? Are they
Yeah.
REITs, or what's
Great
the
question. I would say most of the people that I deal with are individuals, but they're also retail owners. So they have, maybe they own a couple liquor stores, or they own some gas stations. They own, another business that funds their ability to buy these types of assets. And usually they're multi-location, operators that now want to divert the income that they generate from their businesses into long-term investments. So
Yeah.
those are my primary clients. I haven't done too much on the institutional side as of yet, but my primary clients are retail operators that own multi-locations that all now want to invest that money into buying primarily strip centers.
And when they do that, are they looking to occupy part of the space for a new operation? Or
Sometimes, yes. I mean, there's definitely situations where, and this is more so strategic in a lot of senses, because, they may buy a property that, has a vacancy, and instead of, building it out well, they need to build it out anyways, but instead of, marketing it for lease, they'll just say, you know what, I can put my business in there and I can achieve a, whatever margin I can with my business. So I'd rather do that than, lease it out to someone else. And that's definitely happened in scenarios, as well. But it just depends on the user, or the owner, I should say.
Yeah, I can totally appreciate the opportunity to expand your business and also acquire the real estate. I think sometimes there's kind of a line of confusion though when you have the asset and the numbers that, the NOI for the real estate versus the operational aspects of the tenant. And I think because I see that more and more. Like I've been talking with people that are like buying hotels and as opposed to just buying commercial real estate. And you've crossed the line from being a landlord to being an operator kind of thing. And so I think it's an interesting thing, because I think that it's clearly two revenue streams and a neat opportunity, but it's just something that's different. And I would assume in those cases, do most of the I would assume that they're buying the real estate in a different entity than the entity they operate um, their main business. Is that typical?
Yeah.
Or
Yeah. Typically
Yeah.
they'll a lot of times they'll just start a new corporation and purchase the asset in there, and then they, lease it to the, entity that they have for their own operations. So
Right,
they'd sign
right,
a long-term lease for the space, and, at whatever rate. Sometimes it's not as formal, especially if they're going to be occupying it. But, if you're prepping them for sale, you would encourage them, say, hey, look, let's formalize this relationship so that, if you were to sell this to another investor, then they can count on that being the case versus just, kind of flying by the seat of your pants. But that's the type of thing that's, before you list a property, you kind of advise your client on ways to make it as marketable as possible. And also, kind of mentioning to what you referenced, I mean, the opportunity for people who own their own building and they've operated in that space for a long period of time, and they want to execute what's known as a sale and lease back. I mean, that's something that is also a pretty attractive opportunity, where you essentially sign a long-term lease in the building to the extent with which you want to remain in that building. A lot of times it's near the end of your career. Maybe you've been operating a mom and pop shop for a while and you're, 55 or 60, and you say, okay, well, I'll work another 5 or 10 years. We'll sign a 5 or 10 year lease and then sell the building to an investor. And that essentially becomes a investment property. Thus you can use the net operating income as far as to come up with a price for that property. And typically, if it's located in a desirable area, you can achieve a higher price than you could if it just were vacant property.
Oh yeah. I would think if you've got cash flow, that's going to be you're going to have NOI as opposed to just a debt or something like that.
Mm-hmm.
So let's talk about just how you work with investors on how to analyze retail opportunities. I'm assuming you've got leases which equal rent. You've got operating expenses, and you get an NOI and a cap rate. Can you describe, or are there any unique revenue streams? Or are there any unique expenses on the operational side that you have to look at when you're doing that? And then also, if you can describe what's a typical percentage of revenue that the expenses equal in retail.
Yeah, that's a great question. And I think it all unfortunately depends, and it's a function of the leases, right? So, typically in our market, if you're in a retail environment, you'd seek out what's known as a triple net lease, meaning that, the tenant's responsible for a pro rata share of taxes, insurance, and general maintenance on the property. But that's not always what happens. Sometimes landlords, with just not knowing the market well enough, they end up signing a lease with a tenant that's a modified gross or a gross lease, where the tenant is responsible for just one single rent payment, and then the landlord takes on all the operating expenses. And so those are really value add opportunities for investors. As far as other metrics to look at is obviously, I always tell people it's visibility, accessibility, and traffic counts or foot traffic. Like how many people are actually going to be able to see the property from the street or whatever else. How easy is it to access the space? and then what's the traffic counts and foot traffic. And that's more so just related to attracting the tenants to the space, because that's sales is a function of how many people come into the store and ultimately purchase a property. So if you can generate a lot of foot traffic, a lot of people coming into the property, you can typically charge more in rent. And then the next step is obviously analyzing each individual tenant and the leases. Obviously a corporately backed lease is probably going to be more secure than a mom and pop shop that's just opened up a year or two ago. So analyzing what tenants are currently in the space, and if you don't believe that a particular use is going to be successful, because again, if you operate a frame store and the rent is $400 a month and the real market rents are $1,200 or $1,500 a month, is that frame store going to survive at whatever they're paying right now? So you have to do that analysis and say, okay, if they were to vacate, what can I achieve potentially in rents? And then as far as the leases are concerned, just walking through them and getting a feel for what the expenses are, and then what the value add opportunities are. I mean, if the market's triple net and all the leases are modified gross or gross, looking to see when's their expiration date come up, so you can start passing along some of these expenses to the tenants. And then one of the things that really kills investments, unfortunately, is the options. So what an option is it's the right to renew a lease for a predetermined amount and different set of terms once the final lease term is up. So, you may sign a 3-year lease, and then you may have another 3-year option at the end of that lease that specifies, okay, we're going to pay XYZ amount of rent. Here are the terms of the lease. And so what ends up happening sometimes with landlords is that they grant too many options to the tenants, and they end up tying the property up for decades. I've seen some scenarios where they gave them a 3-year lease and then 4 or 5-year options. So, you could the tenant literally could hold you hostage for 20 years. And, unless it's keeping pace with inflation, you're essentially, it's an underperforming asset for that long. So we've walked away from opportunities because of that. So yeah. And again, reading the leases and being very diligent about it. We have like lease abstracts that we create for our clients to make sure they understand all the provisions within the lease and what ways we can add value to it. And then once you get under contract, verifying those values and that information through what's known as an estoppel agreement, where you provide that document to the tenant and they verify that in fact they're paying what rent they're paying, that the security deposit information is correct. And, if there's any outstanding issues with the landlord, that gets addressed before you close on the property. So those are just some tips.
No, I was going to say the triple net lease, I think sometimes it gets referenced, but I've also come to understand there's like a double, or I don't know. It's like there's certain aspects. And you mentioned taxes and insurance, I think, are the two constants. What's the triple? Is that maintenance? Is that
maintenance? Yeah.
Okay.
Yeah. And typically triple net. So the way that triple net or net works, they're called net leases. So there's single net, which operates, they just pay the taxes. Double net is taxes and insurance. And then triple net incorporates general maintenance. So that includes, the interior of the property. Sometimes it includes, some of the exterior, maybe the parking lot, et cetera. But, absolute net, or, there's in other markets and maybe called something different, but that's what you typically see with like a Walgreens, for example, where they literally, if the roof goes out, they'll replace it. If the structure is bad, they'll deal with it. Typically triple net, the responsibility for the roof and structure are on the landlord.
Got it. And in a triple net lease versus a what do you call it when the landlord, just a gross lease, I guess, when the landlord gets all the rent and then pays all the expenses.
Yeah.
So as far as an expense ratio, if you just were to ballpark the difference for doing an analysis, if I had a gross lease and I had rent of X, what would you expect the percent of the rent to be in operational expenses?
Yeah, I mean, that's a great question. And a lot of times it's based on the user that's in the space. Sure. I mean, if you're a heavy energy user, then obviously that's going to, dictate what you can as far as operating expenses are concerned. But, you don't usually see a lot of gross leases in our market as far as retail is concerned. But, as far as triple net is concerned, 20 to 30% max on the operating side. I would imagine if you're looking at a fully gross lease building, you're probably looking closer to 35 or 40%. Expense ratio, which I'm assuming is similar to, apartments.
I was going to say, because typically for multifamily, I think that just a basic rule of thumb is somewhere around 50%.
Mhm.
Just based on, just quick back of the napkin kind of, math, um, just based on, management. I mean, you also have a little bit, I don't know if it's a little bit more, but I would think that kind of the management expense, uh, with leasing, and although you have the same thing, if you have a vacancy
Yeah.
in a retail space, you got to get that filled up there. So,
Yeah,
uh,
and your vacancy rate projections are going to be a little bit different. In retail, it's going to be probably higher than multifamily, but the turnover is going to be less typically. So
right,
you have the 3 to 5 year lease time frame, whereas in multifamily, it's a 1 year commitment. And what's the turnover on that? I'm not sure. It depends on the market, I'm sure.
right. Can you talk a little bit more about the value of the tenant in just their financial wherewithal?
Yeah, I mean that's a good point. So really, when you do a deep dive analysis on all the different tenants, you're just trying to get a feel for what is their likelihood of a being able to fulfill their lease obligation as it currently stands. What's their likelihood of them actually sticking around after their lease term is up? And then if they're underperforming, or not necessarily, if the rents are under market, can they survive if we re up the lease and we push it closer to market rates? So those are types of figures that we try to walk through with our clients. And again, you don't have a crystal ball, so you can't really tell, sometimes, but you can get, as you start looking at a lot of these different tenants, you can get a feel for whether a frame store can pay what a market rate is versus a higher margin business. Like, I know liquor stores put decently high margins. Smoke shops obviously do. You have a variety of different other users that just can support a higher rent payment. But as far as the credit worthiness of tenants, I mean, obviously, franchisees, just because it says, Buffalo Wild Wings, for example, and I don't know if what the franchise requirements are for Buffalo Wild Wings franchisees, but just because it says Buffalo Wild Wings doesn't mean that it's a corporately backed lease. It may just be their first operation they started 2 years ago, and it's just a brother combo that just decided they want to start that. So just because that's the case, that doesn't necessarily mean that they're going to be, a strong tenant long term. So, again, it's just doing a little bit of digging and a little bit of research. So, the more franchises they have, if they're corporately backed, and some tenants are all corporately backed, and they're, a multinational corporation, that's obviously going to be a lot stronger as far as lease is concerned than someone who has a one shop operation. And again, it's just a lot of analysis. And that's why I love retail, because there's a lot of numbers, a lot of things to consider, a lot of check boxes to check. And yeah.
Yeah, I think the analysis in retail seems to be much more critical. And I don't want to say more critical, but I mean more involved in really assessing the tenants.
Mhm.
Whereas I'd say multifamily, it's a matter, did they make the rent? Uh, are they a problem? Kind of thing.
Mhm.
I'm kind of curious on two things. One, on you talked a little bit about the length of the lease and the options. Is there a rule of thumb that you abide by or subscribe to, that kind of is kind of a target for length of lease if you're signing somebody up? Say they're a restaurant, a known brand. Um, is there any kind of guideline
Yeah.
that you work with?
Yeah. I'd say, 3 to 5 years is kind of the standard. If there's going to be a build out involved, sometimes to attract certain tenants, the landlord will offer what's known as tenant improvement, which, essentially you allocate a certain per square foot amount to a build out of a space. So let's say you're going to a restaurant and you're looking to lease 5,000 square feet of space. The landlord may say, you know what, I'll give you, let's say $30 a square foot or $40 a square foot, which equates to 200 grand in build out. That you'll take on the responsibility of doing the build out, but then we'll reimburse you when you provide receipts and whatever else. And so in those scenarios, if they're going to be granting a significant amount of tenant improvement, they're going to want a longer lease. And a lot of times you're going to try to amortize some of that over the course of the lease. So instead of maybe the market rate being $20 a square foot, maybe now you're paying $24 a square foot to cover the fact that, that the landlord's invested that amount into the space for you. And so it's no exact science, but I would say, 3 to 5 years is pretty standard. And then if there's going to be significant build out involved that the landlord's going to take some responsibility for, you're going to be looking for longer leases, in the 7, 10, maybe more range. And then, typically you're going to have the lease rate be higher than market just to amortize that expense over the term of the lease.
And what about the options? You mentioned, you can kind of pin yourself in to where you miss the market. Is there
Yeah.
a kind of a standard 1-2 option after the initial lease, or what's?
Yeah, one is typically what you'll grant. And again, with the options, you just got to be careful with how you word the language as far as the rent increases are concerned, because sometimes you can word it to say 2 to 3% annual increases, which is fine. We've seen others where it's a fixed amount for 5 years and then and jumps up to 10% in the year 6, I guess, all the way to the end of the term. But again, it's just what you can negotiate, especially now with the consumer price index being so volatile. I think that there are historic. I've seen this in the past where I've seen like the increases tied to the CPI, which I'm sure those tenants are shooting themselves right now. So again, it's just all what can you negotiate.
Yeah, yeah. Well, it's fascinating, and I'm sure in your role of doing this on a daily basis, you're able to be a good resource for your clients, and get a good uh, you have a good feel of what the market is, and how to best help both sides. Do you typically represent the landlord, or do you work with the tenant, or is it kind of you list it and then also lease it, or how's that work?
Yeah, so that's a great question. So, I've worked primarily with the tenants as of right now. We don't do a whole lot of property management as of now, but we're starting to get a little bit more into that space. But I have represented the sellers of these centers as well. So it's one of those things where more so on the buy and sale side, and then also on the leasing side, but primarily on the tenant side.
Got it. Got it. And as far as marketing your business, how do most of your clients come to you, or is it you reaching out to them?
Yeah, no, that's a great question. So I'd say that it's a combination of a lot of things. I mean, obviously, I'm very active locally. I'm on several boards locally. I'm on, I run several meetups in town. For one for real estate investing, the other up for commercial real estate. So it's commercial real estate 101 meetup. I have podcasting that I do with a Commercial Real Estate Academy podcast. I've written 7 books, 4 of which were on personal and professional development. When I first was in my previous career, that was just more of a passion project for me. And then now that I've gotten into the commercial real estate space, I've written Before You Sign That Lease, Before You Buy That Building, and I'm working on finalizing Before You Sell That Building, which is going to be a comprehensive guide to sell commercial property. So the goal is to become a series. So it comes from a variety of different ways. I've had clients come to me through just watching me on YouTube. I've had clients that I've met through networking that have been connected to me through other people. I've had clients that I've sourced just through my outreach efforts. So there's a variety of different ways to generate business. Obviously, COVID has been a blessing and a curse in some ways, and that it forced you to be a little bit more creative with how you do your outreach. And so in my case, when COVID first hit, that's when I really went digital, like super heavy with podcasts and YouTube channel, and it's paid dividends so far.
Oh, that's awesome. That's awesome. Hey, Raphael, if we could, I'd like to shift gears here for a minute. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We look to see if first we can avoid the risk. When that's not an option, then we look to see if there's a way we can minimize the risk. And when we can neither avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be clients, investors, tenants, the market, political, interest rates, however you choose to identify or frame the question. But I'd like to ask you if you can, take a look at and answer the question, what is the biggest risk? And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Raphael Collazo, what is the biggest risk?
Yeah, I know. I think we kind of touched on it a little bit early on, and I think that's just a broader risk as a whole. I mean, it's somewhat out of our control what's going to happen over the next 6 to 12 months. I mean, the Fed's going to have a part to play, but geopolitical issues that have been arising and the supply constraints are things that we're trying to work through, but it's going to be a reality for quite some time. So as far as the risk is concerned, if you're a property owner and you're in the retail space in particular, just working with your tenants, getting a pulse on how they're doing, talking to them, just being that the relationship, because again, they as tenants are supporting you as landlord and vice versa. It should be that type of relationship. So in situations where we go into an economic recession, which is likely going to be the case, working with your tenants to try to get them through it if you can, and if not, then obviously repositioning the space to be attractive to particular users, and understanding that what you could maybe charge 2 years ago may not be realistic today, but that's going to change going forward. I mean, as we go through recessions and then we eventually come out of recessions, and so again, it's better to keep a tenant that's good than to lose one and then have to replace them. And I'm sure that's the case that you've dealt with in all different property types.
No, amen to that. If they're paying and they're a good tenant, that's kind of rule one is don't push them out. At least that's my kind of take. Although I know others have kind of a sense of, keep pushing. But I think the turn cost that's kind of a negative. It's a cost, you're not getting ahead on that kind of thing. So I'm more of a subscriber to keep the good ones as long as you can. So I get it.
Yeah. The devil, is better than the devil you don't, as they say. Right?
Yeah, absolutely. Hey, Raphael, where can the listeners go if they'd like to learn more or connect with you?
Oh, for sure. Yeah. So my, they could reach out to me via LinkedIn. I'm pretty active on there. You can check out my website at www.raphaelcollazo.com. I'm pretty easily accessible. Just feel free to reach out. I have my email and phone number and everything on there if they'd like to get in contact. So.
Got it. Raphael, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Definitely. Well, thanks again. It's been an honor, Darren, really.
All mine. All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.